10 losing trades in a row using standard percentage risk will shrink your trade size so aggressively that 20 consecutive winning trades cannot pull your account back to break even. On the other hand, running a static fixed lot size treats a $10,000 account the exact same way it treats a $5,000 account, destroying your capital efficiency. In this video, you will learn how to build a virtual capital system in Python that decouples your position sizing from raw account equity and stops your backtests from lying to you. I build automated trading bots on MetaTrader 5 using Python. I do not sell courses, I do not manage signal groups, and I do not sell indicators. This channel exists for retail traders and software developers who want to understand the unglamorous mathematical mechanics that dictate whether an automated system survives live market execution or dies in slippage and drawdowns. When developers build their first trading algorithms, they almost always start with one of two naive position sizing methods. The first method is static lot sizing, where every single order enters the market at a fixed size like 0.1 lots. The second method is fixed percentage risk, where every order calculates position size as a direct percentage of current account equity, usually set to 1 or 2%. Static lot sizing seems safe because the math is predictable. If your stop loss is 20 pips and your lot size is 0.1 lots, your monetary risk per trade is $20 regardless of market conditions. But this creates a hidden structural flaw inside your trading bot logic. When your balance grows from $5,000 to $15,000, that $20 risk shrinks from 0.4% of your account down to 0.13%. As the account grows, the bot takes progressively less meaningful risk relative to the balance base. The strategy becomes stagnant, and its compound growth rate collapses toward zero. Conversely, if the account drops from $5,000 down to $2,500, that same 0.1 lot size now represents double the relative risk. A system designed to risk 0.4% is now risking 0.8% at the exact moment when capital preservation matters most. To solve this, developers often pivot to fixed percentage risk, thinking it naturally solves the scaling problem. The script queries the broker terminal for current account equity, multiplies that number by your risk fraction, and calculates lot size based on the current stop-loss distance in pips. On paper, this produces those parabolic backtest equity curves that look incredible on social media. In live execution, naive percentage risk introduces an asymmetric recovery burden that actively destroys strategy performance during normal drawdowns. When your account balance drops, your capital base drops, which immediately reduces the absolute lot size of your subsequent trades. To understand why this breaks a bot, you have to look closely at the underlying decay math. Assume you start with an account balance of $10,000 and risk 2% per trade with a fixed 1-to-1 reward-to-risk ratio. If your bot hits a streak of 5 consecutive losing trades, your account balance falls to $9,039. Because your risk is calculated from your active account equity, your next trade will risk 2% of $9,039, which is $180.75, down from your initial $200 risk. Now assume the market regime normalizes and your strategy hits 5 consecutive winning trades. Because your lot size was reduced during the drawdown, those 5 winning trades will not return your balance to $10,000. They will only return your balance to $9,950. You won 5 trades and lost 5 trades with identical stop-loss distances, yet you are down $50 purely due to the position sizing formula. This is the mathematical asymmetry of percentage drawdown. A 10% loss requires an 11.1% gain just to reach break-even. A 20% loss requires a 25% gain. When your position sizing engine continuously shrinks your order volume as equity drops, it forces the bot to work significantly harder on the way up than it did on the way down. The problem is even worse during periods of account expansion. During a strong winning streak, naive percentage risk increases your lot sizes right at the peak of account performance. This guarantees that when the strategy eventually hits its statistical mean reversion and enters a losing sequence, it will be executing its largest trade sizes precisely at the top of the equity curve. If your bot scales up lot size at the top of an equity curve and scales down lot size at the bottom of a drawdown, it is structurally executing high volume at bad times and low volume at good times. The backtest hides this variance drag if the historical sample size is short, but over thousands of trades, this dynamic tears down your expected system payoff. The solution to this problem is to decouple your position sizing logic from raw account equity using a virtual capital system. A virtual capital system maintains an internal mathematical state inside your Python control code that tracks trading performance separately from real-time broker equity, allowing you to control lot sizing dynamics explicitly. Instead of passing raw account balance to your lot sizing module, the virtual capital system calculates position size using a virtual capital base. This virtual base can be defined using several clear models, such as a stepped capital ladder, a trailing equity anchor, or an exponential moving average of account balance. In an exponential moving average virtual capital model, your bot updates its sizing base using a smoothed value of account equity rather than reacting to trade-by-trade balance spikes. If your account takes a 3% drawdown over 2 days, the virtual capital base only drops by a fraction of a percent over that window, preserving your lot size through normal statistical noise. This structural adjustment ensures that when the strategy hits its recovery trades, it enters the market with standard lot sizing rather than crippled contract volumes. The bot recovers from temporary drawdowns and fewer winning trades because it does not allow short-term losses to immediately choke its operational capacity. Here is the noble insight that most system sellers will never tell you about position sizing engines. There is no mathematical model that eliminates downside risk. Position sizing is simply a mechanism for redistributing risk across time. A virtual capital system solves the problem of variance drag and drawdown choking, but it introduces an explicit structural trade-off that you must manage. The trade-off is parameter lag during a true strategy failure. If your underlying trading edge actually dies due to a permanent shift in market structure, a standard percentage risk model will continuously downsize your positions, acting as a natural brake that slows down account destruction. A virtual capital system, because it smooths out balance drops, will keep taking full-size trades deeper into a fatal drawdown. This means a virtual capital system must always be paired with a hard, unalterable circuit breaker. In Python, you write a hard safety ceiling that monitors absolute broker account equity. If real account balance drops below a predetermined structural threshold, say 12% below peak equity, the system bypasses the virtual capital model, closes all open exposure, and kills the automated process immediately. Position sizing should never be used to mask a weak strategy or smooth out an edge that does not exist. Your core strategy must demonstrate a positive expectancy using fixed sizing first. Once positive expectancy is proven, the virtual capital system is implemented purely to optimize capital efficiency and remove the artificial decay caused by raw equity feedback loops. To recap what we covered today. First, static lot sizing creates declining relative returns as your account grows and increasing relative risk as your account shrinks. Second, naive percentage risk creates mathematical drawdown asymmetry, forcing your bot to take tiny trade sizes during recovery phases while taking maximum trade sizes at equity peaks. Third, a virtual capital system built in Python decouples position sizing from raw equity fluctuations, but it requires an absolute hard risk limit to protect against regime collapse. If you want to see the exact Python code for implementing a virtual capital class on MetaTrader 5, hit the subscribe button to catch our practical build logs. In our next video, we are breaking down netting versus hedge modes in MetaTrader 5, and why this single account setting silently breaks straddle execution bots without triggering terminal errors. This video is for educational and informational purposes only and does not constitute financial or investment advice. Algorithmic trading carries substantial risk of loss. This video uses an AI-generated voice narrator.